This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. Sign up for Edge today and take 50% off your first month. Enter promo code at checkout. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings, everyone. Welcome. Thank you so much for attending our Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm joined by our macro advisor, Edge manager, Craig Shapiro. Hey, we have had a pretty eventful past few days, Craig. Let's also remind folks that this is an Ask Us Anything kind of format, and we normally do it around the Fed meeting. But we decided markets are a little bit volatile, and we want to kind of catch you up and help if we can. So without further ado, Craig, why don't you give us a kind of rundown of what's the latest?
Yeah, good. Nice speaking with you again here. What day is today? Wednesday. This week is grinding by as opposed to flying by. Look, I mean, we are, and we've talked about this on the last few webinars and certainly the ones for Edge clients. But, you know, the idea that there are certain times of year that are more susceptible to having macro be the big driver than flows. And when that happens, you know, we need to be mindful of that for sure. And so we had options expiry last week, VIX expiry last Wednesday, and that took a lot of hedging and kind of, you know, both in VIX and in S&Ps off the board. And so what we are left with is a market that is concerned about geopolitical risks. It's concerned about rising yields. It's concerned about the strong dollar, and it's concerned about earnings season. And so, you know, here we are in the throes of that. And I think what we've had this week is a continuation of, you know, the trends that have been in place for the last couple of months, which is a treasury market that is having issues with supply demand as the acceleration of supply of treasuries you know, continues to be poorly digested by the market, as we don't have the Fed buying, banks are struggling to buy, foreign buyers are moving away, and so we're left with retail and hedge funds who are much more price sensitive, and so that's helped to drive yields higher. And we have you know, as far as that supply issue is concerned, you know, these deficits that are coming out continue to accelerate, right? I mean, as of the end of September, the budget office and Treasury put out the estimate for full year 2023. And if you take out the student loan payment accounting adjustments, we basically had a $2 trillion deficit, up from $1 trillion last year. So a $2 trillion deficit is, you know, over close to 7% of GDP. And that's in an economy that's operating at full employment with obviously very sticky and elevated inflation. So, and there is really no signs of slowdown as far as these deficits are concerned. Even right now, as the House finally has put a speaker in, the administration is looking for $120 billion of additional spending on Ukraine, Israel, Taiwan, the border, various other things, which wasn't even expected, you know, 4 weeks ago when the government shut down. So now we have we're staring at, you know, potential of another government shutdown on November 17th. They've put in a new speaker who is, you know, to the right of McCarthy. So, you know, how is he going to deal with you know, these spending expectations? It's going to be challenging. So we're going to face potential for a government shutdown again. And if not, and we just do another continuing resolution, it's just going to be bigger deficits, bigger supply. Next week, we have the quarterly refunding announcement. We can talk about that in a little bit and what the Treasury might do with respect to bills versus duration. That'll be an important driver for next week. And next week, we have the Fed as well. And as for the Fed, they're a blackout now. But last week, Powell spoke and, you know, really intonated that while it's unlikely that the Fed is going to be raising rates, certainly not in November. The odds are basically zero. And even for December, despite better data, the odds are, you know, very low, so 25%. There is, you know, a view potentially at the Fed that maybe more needs to be done. And Powell doesn't believe that we are necessarily in restricted territory. And if we continue to get strong economic data, which tomorrow will be another tell on that, we have GDP tomorrow. Atlanta Fed GDP estimate is 5.4% for the third quarter. Consensus is looking for 4.5%. So if we continue to get this strong data, and then we have the PCE on Friday, the Fed is going to be in a very tough situation here where they should be doing more in order to slow this economy down, and they're not. And so the markets are grappling.
So much of that GDP print tomorrow, though, is inclusive of government spending. So we've got to parse that out. Is PCE of interest to you, which comes out on Friday? You know, I'm always looking at jobless claims on Thursday morning, but in particular, kind of flat to rising inflation is, again, a nice tailwind for yields, and not that they need it with geopolitical risk and just rising risk premium. But what do you think is the deal there in regards to the PCE? What are you expecting?
So yeah, tomorrow is claims. That will be important. And PCE is always important. And there's been a trend of late where core PCE has, shown some improvement. The issue is that core services PCE has really not shown much improvement. And so that's core services ex housing. And that data point on the CPI was actually a very concerning figure. And it was up towards 0.61% month on month. It was the third month in a row of gains on a sequential basis. So I think there is hope that from the Fed that they will see more momentum on this core services ex housing inflation print. But to the extent that that does not happen, that is a very big concern because we are not seeing a slowdown in the labor market, commensurate with a return of inflation back down to 2%. Because the labor market, the strength of the labor market and wages is the biggest driver of core services ex housing inflation. And if we don't slow the labor market and we don't slow wages, we're really not going to get that figure back down to 2%. And I think there was some discussion today about UAW and Ford coming to an agreement. So the idea there is a 30% all-in rise in wages and benefits over a 4-year period. So that's, 7.5% a year gains versus a 2% inflation. We're just not going to get there with that kind of labor market momentum. And then, you'll say, oh, well, unionized labor force is small and what have you. But we've seen this time and again, right? Kaiser healthcare workers, 6% wage increase. Even the federal government next year is seeing a 5.2% wage increase. And as more wage gains are seen by unions, more people are going to join unions, and more people are going to want others to represent them, and are going to continue to look for wage gains that help keep up with inflation. So I've said this before, but in order to break that cycle of wages, we need to get layoffs. And in order to get layoffs, company CEOs need to be upset about their stock prices. And stock prices falling forces layoffs. And so if we don't get stock, look, we're starting to see stock prices fall, right? IWMs are making a low for the year. Many,
it's down 5% for that.
Many sectors that are away from big tech and away from energy are starting to, see some layoffs. But where the biggest employers, whether it's the Amazons or Walmarts or whatnot, they're not there yet. So, but more stock price underperformance will lead CEOs to start making decisions about payroll for employment for next year, and that's how you kick off this cycle of stocks down means job cuts, which hits the wage market, which is how you bring core services inflation back down to 2%. So that's a dicey setup for equities, in that environment.
Because it's slowly then all at once. Once they start to see the WARN notices turn into layoffs, then the companies that are small to mid-size that are kind of hanging in there but suffering, they're waiting for cover to lay off, they come all on at the same time. So it does tend to be a trickle and then a flood. So there are estimates as far as when that's going to start to hit. Could be end of quarter or beginning of next year, but it seems to be very, very close. But we haven't seen any indication of it yet. So on recession risk, what do you look for? And I know we got a question mark. I see that. Don't worry about it. I'm going to answer that. But in regards to recession risk, what do you look for besides, uninversion of the yield curve and rising employment? Besides those two big.
Yeah. Look, I think what we're getting is, look, after a 4.5% GDP print for the third quarter, the idea that we're near a recession, I think is, not, we're not there, right? We're whether or not we're close or not, and we could argue about that. But there certainly are areas of the economy that are more sensitive to the rise in rates than not. And so the question is, are we going to have these rolling recessions where certain sectors go into recession, other sectors are doing well, and then as those fall down, other ones come back up again, and so the broad economy doesn't fall? Or are we going to get a something that's much nastier where credit spreads start to widen out and companies start to struggle? We get these layoffs. Ultimately, I think we are going to get the latter case. I mean, the idea that we could have an economy that sees 500 plus basis points of interest rate hikes off zero and continued quantitative tightening and not see a more protracted slowdown in the economy, I think that's and get inflation down to 2%. I think that's not going to happen. But it's taking longer than anybody thought. And that's because, as we discussed, corporates and for the most part, and households have termed out their debt for, during COVID at low rates for long duration. And so that window, that maturity window is further than it normally would be. And so from a high yield perspective, there'll be some maturities next year, but really the wall doesn't really kick off until 2025 and 2026. As far as households are concerned, look, I mean, people who have a low mortgage, they're locked in, they're not moving anywhere. And so what we have is a housing market that's very bifurcated, where people who have homes with good mortgages are not going anywhere. People still want, but people who have jobs without homes can't find homes. And so I think you probably saw today, new home sales in the US hit an 18-month high this month. So again, is the housing market slow or not slow? I mean, it's hard to really argue that housing is leading us into a recession when we're printing new highs in home sales. So I think it's more likely that we're going to see this turn in the data in the first quarter of next year. I mean, PMIs, service sector PMIs, in the low 50s. I think that'll, gradually roll over. And if energy prices stay firm, amidst the geopolitical, there's going to be consumer wallet share that moves to energy and away from other things. So that's a headwind. But look, ultimately, calling recession or not, I mean, I think is, it's fun to talk about, but whether or not it matters for making money, I don't really think it really matters. The Fed's mandate is employment and inflation. And in order to bring inflation back down to target, they need to get the unemployment rate. And so that's where we're going. And as long as inflation is not going back down to target, it becomes more difficult for the Fed to provide liquidity, incremental dollar liquidity, like the market is used to getting, right? We've had 15 plus years of a ZERP mentality, of a Fed reaction function mentality, where at the earliest signs of growth slowdown, the Fed is ultimately, right there at your back. And, at the risk of saying this time is different, I think in an environment where inflation remains sticky, there is something different about the Fed's reaction function than what we've had the last 15 years. You have to really go back to the 1970s, 1980s Fed reaction function, where inflation is, a concern. And so a market that thirsts for liquidity is not going to find it at the hands of the Fed. And as growth slows and inflation is sticky and that stagflation sets in, that's a toxic environment for risk taking, in my opinion.
So I have up here a screen share just because it prompted my thinking when you were talking about the kind of economic. Well, first of all, GDP coming out tomorrow. There's still a lot of fluff in that nominal, but from a standpoint of a kind of economic grind, we're not really exploding higher in growth, right? From kind of the PMI figures that we just had this week, it's pretty, it's fine. It beats the alternative. But in regards to this rising yield backdrop, I kind of bring that up because this is not blowing anybody away just because we have some kind of firm 50, not too hot, not too cold levels. The yields are definitely rising for other reasons. So kind of your top three reasons why you see yields are rising up. It's not from economic growth per se.
Yeah, look, I think that the yield story is multifaceted. I think the Fed has, talked about the idea that they're perplexed by the move in the long end. In my view, it's clear that the U.S. government deficits are becoming more top of mind. And, I think people are, are cognizant that the U.S. government has exploding deficits and can't really ever rectify those, but it hasn't been a problem before. But now the reason it's a problem, or it's becoming more of a top of mind problem, is you see the dysfunction in DC. You see neither side really willing to cut spending in any material way. And neither side wants, feels like look, the Democrats want to raise taxes, but Republicans are very much against raising taxes. So if we can't raise taxes and we can't cut any spending, and you have the two frontrunners in Biden and Trump, who are both basically deficit busting, spenders. Where do we ever get to a point where
relief
the government will stop the insanity, right? I mean, a $2 trillion deficit at full employment, it's crazy, really. And so I think the bond market is waking up to that reality, and as we've lost these traditional price insensitive buyers, but the Fed or foreign central banks, then look, retail and the hedge fund sector are more sensitive, and so that's part of the yield. So look, on the growth side, I think it is important, right, to see, and that this ties into the budget. Much of the growth, is being driven by this deficit, right? So 8% GDP deficits are leading to a robust nominal growth, and as consumers have more money to spend, because our high income consumers or high saving consumers, old elderly consumers who are living off of Social Security, that have a 9% cost of living increase in 2023, and another, I believe, 4% is going next year. So, they have all this money in the bank. They're living off that, and they can earn 5.5% by investing in a bank, really, and CDs or in 3-month treasuries. So that spending is going right back into the economy. So I think that's another reason where the Fed has said we need to be higher for longer. The bond market is saying, okay, higher for longer means 10-year yields need to be higher and 30-year yields need to be higher. And so we're getting both of those dynamics in play. And then the last thing I'd say on inflation is, amidst the deglobalizing world with poor demographics, where wages and labor are likely to remain tighter, and energy is likely to remain tighter, and supply chains need to be built out because we can't trust our enemies anymore. That's inflationary. And so if that's inflationary, then, bonds and inflation volatility is rising. Bond prices need to fall and yields need to be higher to, compensate investors for that risk of inflation.
Mark asks a question in regards to kind of why I still see yields rising, and you just kind of summarized it well, and not even the geopolitical side, but risk premium that is being demanded in the higher yield regime. Can you talk a little bit about term premium, just because it makes a big impact on the stickiness of these rising yields?
Yeah. So look, term premium basically is the compensation. And as we're talking here, I know Meta's out right now, and actually dollar yen is moving too. So Meta's out up 3.5%, but dollar yen here is making a high for the day, 150.13. So look, that's a very important thing. There is a lot of option expiry in dollar yen for Friday at the 150 strike. So look, I think that's been keeping dollar yen under wraps. But if we explode through this, I think that's going to be a very risk off. But back to term premium. Term premium is just the incremental compensation that you demand from holding, let's say, a 10-year versus a short-term instrument, where you could, if you had a 1-year note, you could roll that every year for the next 10 years to create some sort of yield structure versus the 10-year today. And so typically you would command a yield premium, where term premiums would be positive, to hold that 10-year paper, because there's inflation volatility and there's risk. Now, based on QE and based on the spending, term premiums went incredibly negative. But there are now, and that was exacerbated by the Treasury's decision to do more bills, less bonds, to spend down the TGA. So there was a dearth of Treasury supply in the market for the first 6 months of the year. Which really took term premiums down to very significant levels. What we've seen over the last couple of months is term premiums moving back to neutral and now are modestly positive. So there is some incremental compensation that is being earned from by investing in the long end versus the short end. From here, the question will be, how much does this Treasury continue to issue out the long end versus bills? There's some discussion about that. Next week, we'll get the next update for the first quarter of next year. We already have the fourth quarter schedule in place. The first quarter of 24 information will be given. So there is some hope in the market that Treasury will flip back to issuing more bills than bonds. Look, they're already issuing issuing more bills than bonds. But there's some hope that they will issue even more bills and cut down bonds issuance for first quarter, because the theory goes that, well, because they're fearful that with yields moving up as they have, they should issue more, they should issue less. There's risk to that as well, because look, that means as Treasury is issuing shorter and shorter paper and is rolling that paper over and over again, it's paying even more out, right? I mean, 3-month T-bills are 5.35%, and the 10-year is 5%, 4.9%. So it's more expensive for Treasury to enact that bill strategy. So I'm skeptical that they're going to flip back to bills. I think they're going to continue doing what they're doing, which is issue incrementally more bonds in the first quarter than they did in the fourth quarter. But we'll see. We'll find that information out on Wednesday of next week.
I'm bringing up a chart right now that you can see. I actually grabbed it from Twitter, Bob Elliott. Real rates are pretty low on an outright basis and on a total tightening basis. I just happen to like this chart because from a technical level, that is a V shape of strength. And we haven't even reached a level where we have seen the recession or the stress actually in the marketplace, like in the prior pivots that are obviously encircled in red. Comments on that chart, because I thought it was a really good one today.
Yeah, look, I think this is part of the market's struggle is there are less and less people around that have traded prior to that gray bar in 2007 and 8, right? There is a huge universe of today's capital is managed by people who have only traded with real rates below zero. And so I think you really need to go back and kind of study history and kind of study. And it's not that this time is different. You could argue that the period from 2008 to 2021 was the different period. And we should go back to, some sort of period that looks like the 1970s, 80s, 90s, and early 2000s of a positive, real rate environment. Like that's how normal economies work. Now, given the debt load that we have here in the US, it may be difficult, to really move back to that 3%-ish policy rate. And that's where, things typically break. But look, I think to believe that we're going to go back to some ZIRP environment or some significantly negative real rate environment when inflation is as high and as sticky as it is now, I think that's the wrong assumption. And I think investors have been making that wrong assumption, for the last year plus, thinking that at every turn, the Fed is going to deliver a dovish, move. And, they while they haven't gone all the way in getting their inflation down to their target, they certainly have been acting different than they had been, let's say, prior to 2020 with respect to they're not cutting rates. They have pushed out the rate cutting agenda. They were even more hawkish at the September meeting to the market than even I was thinking, which was they are only now looking for 2 cuts in 2024, where previously they were looking for 4. So I think the Fed they've done I don't think they've done a great job, right? We're still not getting to 2% until 2025. And, if it took me 5 years to get to, my employment target, I'd probably be fired. But, they're still around. But they haven't done a horrible job. They could have done a lot better. But I think investors need to realize that they're not moving back to, something that existed in 2008 to 2000. I think it's profound implications for how you set up your portfolio. I mean, we've had a generation portfolio set up on 60-40 type, backdrops, some combination of stocks hedged with bonds, lowers your overall volatility of your portfolio and increases your Sharpe ratio. And that, I think those days are not with us. Bonds are not a great hedge to stocks. And currently, the relative valuation premium of stocks versus bonds. I was reading a Hussman article about this. We haven't seen these levels of overvaluation of stocks versus bonds since 1929. And first quarter of 2000. So this is not a particularly safe time to be over allocated to either equities or bonds. But and she would agree, the cat. Look, this is I think we're going to have to be looking for alternatives here, whether it's in commodities, whether it's in cash-like instruments. It's going to be challenging.
All right. So that bull bear argument, though, right? So positive real rates are a sign of health. But at the same time, that chart really indicates to me that, guess what? They're just not done. So there's definitely lack of safety in that bond trade. The question I just wanted to answer a little bit later, because I wanted to give you kind of time to frame all this out, was my bet has been obviously that there's nothing changed in regards to my intermarket for this continued sell-off in bonds. We can have a panic, we can have an intervention, but and that includes from equities falling, Fed intervening. We've had obviously liquidity thrown into the market at times when it got a little dangerous, like September, October timeframe. But tops are processes, bottoms are an event, and there's nothing yet that signifies to me that bonds are done falling. But as far as reasons, clearly fiscal dominance or quasi-fiscal management is the buzzword today, but it's basically just this rising massive treasury issuance in response to fiscal deficits. So I don't really think the Fed has to do too much. I think the market's doing it for them, long story short. So I don't think that the Fed has to hike. I think they just pause. I think they let the inflation expectations and this concept of nominal GDP helping to also give the bulls their argument, and the bears are of course focused on the fact that the tightening hasn't even reached the choke point, as that chart just kind of pointed out. We continue to see foreign central bank selling. Buyers are just demanding more of that compensation for taking on the risk. So I don't see any reason for this short to end without some type of intervention or event. So I think they're going to continue to rise and bonds are going to continue to fall, and we'll have some panic moments of buying, but otherwise not safe. So that hasn't changed. Georgie's asking about realistic scenario of restocking cycle helping the ISMs turn up, and also while services roll over, essentially the reverse of what has happened of late. Any suggestions as to kind of the back?
Yeah, well, look, I mean, I think there is some case to be made for that. I would caution, though, that manufacturing is 10 to 15% of the economy, and services are 60% of the economy. So, while there may be sector rotation in that understanding, look, if services really start to roll over because we start to lay people off and folks are concerned about travel or what have discretionary spending, then that'll be more important. So yeah, look, I think inventories are fine, right? We've worked down the supply chain. Has been any issues in the supply chain, everything overbuying, that's kind of all gone. And so there's a bit of hand to mouth operating in the manufacturing part of the economy now. And there certainly are some structural trends for U.S. manufacturing in a deglobalizing world, as even the government spends money on the CHIPS Act and and on minerals and on different things to try to improve our domestic self-sufficiency. So there'll be kind of some structural and infrastructure spending. I think there are some medium to longer term, needs for U.S. manufacturing to rebuild out. But manufacturing is not a big driver of our economy, as big of a driver of our economy as the consumer is. And so I think its overall impact on the Fed and on earnings are less than that people realize. And
what's your kind of view of year-end performance given the macro headwinds? Now, right now, we don't have the flow, if you will, the CTA buying the positive gamma to really provide this tailwind for equities, and earnings are disappointing overall. And this week we have like 32% of the S&P report, so we'll get a much bigger picture. But long story short, we have the macro triggers right now that are helping the market to soften. What's your kind of end of year scenario for?
Yeah, I am, and I've been saying I've been looking for the second half of October into early November as a significant window of weakness being open, where macro really can overwhelm. And if earnings didn't come through, which the jury's still out, right? We're still not, we're still in the early part of earnings season, but so far it's been a struggle. And today with Google and look, Microsoft was up, Google was down, Texas Instruments was down, Meta's flat after the close. That's important. Amazon and Apple's next week. But even some of the industrial earnings have been, airline earnings were terrible. So it's not, these aren't the type of earnings that are like blowing people away and saying, I need to be in stocks for the year end earnings reacceleration.
No, they're actually really bad.
Right. So I mean, this hasn't been a reason to.
And the bar was low. So Data Trek actually came out on the 23rd. and said Q3 U.S. earnings season has started poorly with fewer than average companies beating estimates. Analysts are taking Q3, Q4 numbers down as a result this week when 32% of the S&P reports, they need to do better. And so far, not so far. They're not doing. But even before that, I have to show this particular, hopefully I can show this a little bit. Hold on, fit to screen. There we go. Hold that thought. I love this chart. Nope, that's not it. Share screen. There we go. All right. So this is interesting. Where are we at? Speaking of earnings, lots of expectations of beating because the bar was so low relative to last year. But stocks under the surface have been selling off quite aggressively. And I grabbed this. This is the percent of stocks in their respective sectors that are already in a bear market. So 68% of real estate stocks are already in a bear market. The only one that's kind of hanging in there is energy. And that has been a nice kind of softening underneath. We talked about this. This was on your sector rotation as way extended, right? And so usually we get a little bit of rotation, but they're not going into tech other than the mega cap. Magnificent. It was 8, then it's 7. It might be 6 or 5 now. But anyway, this is, I just thought, very compelling to kind of demonstrate what I have been seeing since that massive treasury issuance on July 31st that you spotted often and we're waiting for, and we have just rolled over solidly, maybe not so much in the top line, SPY and NASDAQ, but underneath it has been deplorable breadth destruction. I mean, serious, like COVID, serious breadth destruction. And that's something that I track in the live trading room. And because we saw it, it just never, ever stopped going down. Even when everyone during COVID was like, buy the dip. I'm like, no, the net selling is still there. The breadth destruction is still strong. And then when I saw this on Twitter, I'm like, that represents exactly, by sector, how poor the market has been. Anyway, just had to point that out. So I'm definitely not a bull.
Yeah, look, I mean, I think, if we're trying to nail the timing, the way I'm kind of thinking about it is the next 1 to 2 weeks here is a very ominous time where macro overwhelms flows. The early part of earnings season has not been good. We have rising geopolitical concerns, and we don't have, because of where we are in the month, we don't have the kind of structural flows, the buyback flows that would happen around options expiry and the likes. Now we are, as we transition through this week, we will reintroduce buybacks, which is supportive for year end, and there are a lot of year-end dynamics in play in a year where the NASDAQ has done as well as it has. There's a lot of, folks who have structured products that, that came online the fourth quarter of last year that are well in the money. And there's some buyback flows, and there's less days of trading in November and December. And so there's this natural idea of a year-end rally potential as we, come into, and certainly as we come into the November and then for sure the December expiry, which are big structured product expiry windows, as we talked about. So that would be the bias. Would that be we could have some benefit into year end after this sell off that I would expect in the next 1 to 2 weeks. However, we're doing a lot of structural damage now to the tape. S&P's below the 200-day, 50 is under the 100-day. We're starting to chop off more and more names. The chart you just showed about the breadth deterioration. So look,
these are the ones that matter to me. I mean, all of that is because we have such an incredibly strong macro risk backdrop of dollar and yields. I mean, this is the dollar on a weekly. The longer it stays above this kind of 105, 106 area, the more bullish it gets. This is on a daily. That's a headwind. Bonds obviously are continuing to just fall out of a 40-year long trend line. I mean, perfect technical rollover despite that central bank coordinated intervention here in September, October. It's deplorable weakness. So, long story short, we also have, oh my God, hold on, currencies. Where are we? Where's the yen? There we go. All right. So what the heck? This is the dollar yen on a weekly that you just mentioned because it's alarming, right? We know it's compressed here at this 150, and Bank of Japan says, hey, you may not, continue. Well, over here on the other side, you got the JGBs, and they are just like very strong. If 80, then 100 type of strong. So yeah, those are some major macro headwinds in addition to everything you've just talked about.
No, look, I mean, the macro setup would suggest, continued pain for risk assets, likely through year end. That's how I would describe it, unless we get some dollar liquidity release, which I don't anticipate we're going to get unless something breaks. And so far, since nothing has broken, we're not going to get that. So the macro suggests bad. But I think what we need to keep in mind, and I've been fooled by this plenty of times this year, is that time winds up not being a bear's friend. And by that, I mean, normally we think of, gravity is, kind of pulling markets down or pulling things down. But in this case, the gravity that is associated with time and the VIX and volatility makes, levitates markets, right? If we don't get a continuation of selling and of move, like the VIX is 20, if we don't get moves north of 1% or 1.5% in a day, then there will be vol selling. And as there is vol selling, it levitates the S&P and it levitates the big cap names, which are the biggest components of the S&P. So there is this structured product, structured volatility dynamic in play that at certain times, and I know it sounds crazy, but we've seen it time and time again, it offsets the macro headwinds, right? I mean, so there are windows where the flows just matter more than the macro. And as you think about it, into next week, right, volatility is going to be very, very elevated into the Fed meeting, into the BOJ meeting, which is Monday. The Fed is Wednesday. The QRA from Treasury is Wednesday, and then payrolls are Friday, right? We have a very elevated vol window next week. As we pass through that, unless the market is moving 1% to 2% a day, realized volatility is going to fall, and then vol sellers are going to come in, and then we're going to get into November expiry, and that's going to be your potential window to bounce. So we just need to keep those timing windows in mind when we're looking at it. So that is the most bullish thing for year end is that time and lack of trading days, structured product volatility around expiry windows, and the fact that the Magnificent Seven stocks are up on the year typically creates that dynamic of year end window dressing. Other than that, we should be and likely will move materially lower in risk.
And that this is what I am eyes on the prize when it comes to calling, right, this volatility surge intraday, day to day, week over week. We're still in it. So in my humble but strong opinion, volatility is not done going up. So this is something that, you and I talk about, obviously, over the days and weeks and months, but we're definitely in a risk off mode. For how long? I don't know, but the capitulation bottom is not in. And one thing I want to kind of take a little break here and highlight for anyone who is not aware, this is something that, Craig focuses on every day from a macro standpoint. No question about it, macro event risk. And then, of course, trading his book. Like, how long have you been short small caps now, right? I mean, we rolled over so aggressively back in July with SPY and NASDAQ, but you have been short small caps as a manifestation of your macro call. Anyway,
we've caught the gold move recently, the Bitcoin move recently. So look, this is the type of thing that I am chatting with folks about in my room throughout the course of the day and in direct message. And I'm just trying to be an outsourced macro consultant to people who are looking at the world that way. If you're looking for day trades and setups, the morning meeting that you're doing is great for that, and the work that you're doing is that. But as folks are thinking about some more medium term, where they want to be positioned, I think look, I was talking to one of the clients last week, and I said he was just saying like the best thing that he did this year was get out of duration. When we called it, at the middle of July, end of July, he's like, I've saved my clients. He's a private, client advisor. He's like, I've saved clients so much money by moving everything to the front end, and having no bond risk on. And that was a huge call, and that call, continues. And so that's the stuff we're talking about, throughout the course of the day.
And the reason why I bring it up is because we don't have these public-facing webinars so often. And because we're in a really kind of treacherous, I would say, risk profile for the next few weeks, I want to make this offer available, which we also don't make very often. It's a coupon code SAM350. And again, we do these publicly for free, these macro to micro power hours, and then we do them for clients on a regular basis, not to mention be fully accessible and available for clients day in and day out. I mean, oh my God. So the engagement's very, very high. But this is one to definitely consider if you are looking at managing portfolio risk, interested in the reason for the season of why macro moves the way it does, and then actual trading setups. Definitely check out this most recent opportunity, which is very, very time limited because we've not done this before. I want to see if this timing with the next 2 weeks is going to kind of fulfill this destiny that you and I have been talking about, which it was not the bull consensus. The bull consensus was seasonality should have started by now. All systems go, and then absolutely that didn't happen. But you and I were very strong that it was not going to happen. So anyway, join us for that. It's a lot of kind of pro support if you need it. Even chase swing trend portfolios, it's all included. So any other questions, definitely hit us up because it is being recorded for sure. And I think that the gist of it is that we have some macro event risk that's not done, not the least of which is FOMC, but no expected changes. I'm looking at non-farm payrolls as well as weekly jobless claims, but NFP comes out on November 3rd. If we do see a resumption of that trend higher off the bottom from literally, we've already moved 0.4%. There's a SOM rule that's very strong with a 100% hit rate that recession risk gets pulled forward on that trigger, and it could come at any month. So I'm always on guard for that, especially in this backdrop where earnings were, priced for perfection last quarter and easy bar this quarter, and they're disappointing. And the sector breakdowns have been stunning, like as in forced selling in some cases with this higher cost of capital, which literally picked up once we got above that 4.1. But my big warning was above 4.7. And just to kind of reiterate, this was something from last year that I said in September that that this year we would see 4.7%. That was my baseline bet for the 10-year. But once we got above it and stayed above it, I saw equities rolling over hard, like literally another 20%. So whenever we triggered that 4.7, I've been on client alert, warning, this is not a drill. Protect your trends. Think very hard about these swing longs that you might have. Let's enter into this kind of swing short regime, see where it takes us. It's taken us quite far and quite well. Now we have to look for a capitulation low, which I have not seen. So, long story short, I think we're still in the meat of the danger. And even if we do have a bounce at this point, it will really have to be compelling for me, and it's going to have to be tested and proven, right, for this to really be a compelling swing long. I don't know if we're going to see it this year. And I think my baseline bet has turned. I think that the max kind of pain that could be doled out is if we don't have that performance chase like you asked about, Georgie. We only have 2 months left. What are the chances for a performance chase? I don't know, because right now it looks like the max pain level for the market would be 3,800. It's not so far away. That's not such hard to envision, but that's flat for the year. So it's really on the shoulders of the magnificent, again, it was 8, 7, 5, whatever number we're at. In other words, they've rolled over, the trends have broken. It's on their shoulders to deliver us, and energy, oil and gas companies to not, succumb to profit taking, and for Bitcoin to save us. So we don't really have a lot of safe assets, the safe haven assets, and treasuries are definitely not that. So I'm actually looking at that 3,800 as a high kind of probability now. If we take out some key technical levels, and I've got eyes on the prize, I would wait until we're through that kind of mid-November, as you just talked about, all the macro event stuff that's coming up, Bank of Japan as well. But in the meantime, everything is full on risk off as far as I'm concerned, with the dollar where it's at, yields where it's at, dollar yen and JGBs looking like they're just ready to bust a gut higher. So I'm definitely not in the capitulation low camp, not yet.
Yeah, tomorrow the ECB meeting is unlikely to, the odds of a hike are basically zero. But look, the ECB and Europe is going through similar situation to Japan in that rising energy prices are leading to a more inflationary backdrop. The ECB is a one mandate central bank that just looks at inflation. So even though they're gonna pause, and the market's gonna say, well, what about this energy inflation that's coming back again as now Europe is going to struggle with two wars that could impact energy price and energy security. So my sense is if the ECB doesn't do anything tomorrow, which they're not anticipating to, I think it's going to be a risk off move for the euro. Dollar euro could take another couple handles lower. DXY, that's your DXY moving higher phase. We have the GDP print tomorrow, like we talked about. Look, I think there would be some hope in markets that number comes in light. And if it came in light, you would have the dollar could sell off, bonds could rally. There would be some relief that the growth that anyone who was selling bonds because of growth in the third quarter, maybe maybe that's a bad idea. This growth didn't come in as good as we thought, if that's how the data comes out. Friday, we get the PCE and the University of Michigan inflation expectations reading. So PCE is important, as we talked about. Some hope from the Fed that number, particularly the core side, will be decelerating. If that doesn't happen, we're going to see dollar up, yields up. And then University of Michigan final reading, that was a big surprise in the middle of the month when the preliminary reading came out. We'll see if that gets confirmed in the final reading after 2 more weeks of elevated geopolitical concern. And then next week is really the Super Bowl again of data. We have on Monday, we have the BOJ. It's the last day of the month. We also have Treasury will give us at 3:00 in the afternoon. On Monday, we'll get the total amount of borrowing that is going to be needed in the first quarter of 2024. We'll get an update on the fourth quarter borrowing amount. Unlikely to move too much. And we're also going to get an update on the end of quarter cash balance. And then on Wednesday morning, so on Tuesday, we'll get JOLTS, we'll get ISM. Then on Wednesday, we'll get the final reading from the Treasury on the duration supply question. So are they going to be issuing more bonds than they did in the fourth quarter again? So that'll be a very telling statement from Treasury, and that'll have drastic implications potentially on the bond market. And then in the afternoon on Wednesday, we get the Fed, and Friday, we get payrolls. So it's a busy week. Macro will still be overwhelming flows. So stay tuned for a lot of potential fireworks. But what I would say is that volatility is elevated. Now, the VIX market volatility is in contango. Vol for the Fed is higher than we are for vol right now. So, as we push through those dates and they come and go, as time moves on, there will be kind of this natural vol selling unless we get some negative surprise. I don't suspect. I think it's gonna be hard for the Fed to hawkishly surprise the market. I don't know why they would do that at this point, but you never know. There's no update on the dots or on the economic readings, but Powell will give a press conference and he will address the move in the bond market and whether or not that's doing the work for the Fed for them and what they think about the recent inflation data and the like. So look, I think a hot PCE on Friday is likely to take the odds up for the December meeting, which right now are pretty low. And I think that is something that will be, risk off, because I don't suspect markets are going to take kindly to another rate hike this year amidst, what they're seeing geopolitically.
And I don't see it, period. I don't think they have to. Can you comment on small caps and your position? I happen to be putting up a chart that is monthly relative. It's a ratio relative to SPX. And recently it took out the 2008 lows. So it's a little chunky looking, but it's literally IWM to SPX. So you asked a question about the kind of levels down here. Where do we go from here? We're already down 5% on the year. We've already broken below. And, Craig has been spot on saying this is where you're going to have the major representation of weakness due to the rising yields. I am saying this is not a value shopping, network here. This is a value trap right now until we can get some stabilization. So I actually think this is just like bonds. Honestly, they're not safe.
Yeah. Look, IWM now is taken out, I think, as of today, and it hit on this before, but we're below now the pre-COVID high for IWMs. So
Mhm.
look, I think, structurally, at least 40%, maybe even more of IWM are not profitable companies. Look, we have financial leverage, operating leverage in these companies. They are more apt to be hit by the rising cost of capital and sticky cost of capital. So that there's more refi risk in these names. There's a heavy financials component in here, regional
Mhm.
banks and other financials that are going to continue to struggle in
Here, look at my
this.
chart again.
So
There's a lot of them right there.
I still think IWMs are, look, they've relatively underperformed for sure, but I don't really see a reason why capital is going to try to find a bottom in IWM,
Yeah.
this year. I think what you'll likely get is people who are looking, into next year and are, there may be some, I want to get out of tech and big cap and into, but there may be some trade at the beginning of the year where folks
They'll
want to
be cheap.
reallocate.
At some point, they'll be cheap
But
enough.
the truth is right now, like I said earlier, relative to bonds, Russell valuations are basically at the all-time highs. So this is still not cheap. I mean, if I were looking for, a target here, there's a gap to fill at, from middle of 2020 at like 161 and change, and then the 61.8 retrace of the entire COVID low to the entire high is down at 152 and change. So I think those are, some short-term, targets here, and then maybe it needs to bounce around the 152 to 170 level. Whereas, look, for the most part, for the last 2 years, it's been bouncing between 170 and 200. Maybe the new range is, 140 to 170, right? And we got to start carving out this new lower range over the course of the next, 6 to 12 months. So I think that's very, very high potential.
Unless this happens.
Look, when credit ultimately starts to widen out, we will have, a very precarious setup for small caps and for many cyclical names and for the markets in general. I think there is still in 2024, broadly speaking, not as much in the way of maturities. But 2025, there is a huge amount of maturities that start, and then again in 26 and then 27. I think what many corporates are looking for or hoping for is, some bond market rally here, maybe in a slowdown or something else, in order to find times for them to refinance. But the window has largely been closed for certainly the last 3 months, and unlikely to reopen unless dollar liquidity is brought back into the market. And the question is, why is the Fed or Treasury going to bring in dollar liquidity into this market at this point? And the reason that could happen is because Treasury market starts to dysfunction, hasn't happened yet. Some banks start to really struggle again, hasn't happened yet. Some country somewhere starts to blow up and we start to see spreads blow out, hasn't happened yet. So I think it's likely to happen, and this is my argument for the next 1 to 2 weeks of risk, and maybe risk into the end of the year. We are going to see things break, and that has a high likelihood of bringing the Fed liquidity idea back into play. But we need to do the order of operations first. We need to get the pain first in order to bring in the liquidity. And I see someone's asking about gold, and I'll even just
that's why I have this dollar yen on the we got to end on gold.
Gold, in my view, I think there's there's a bunch of things that are going for gold, but broadly speaking, gold will anticipate the eventual need for liquidity that comes into markets. So I think that's part of the reason why gold has been outperforming and has been rallying recently with the dollar, is that this dollar strength is starting to break some things abroad, and so the gold market's saying, well, eventually it's going to break a lot of things, and so gold anticipates that. Get your allocation into gold. Gold also does well in times of geopolitical concern, and gold also, from a structural point of view, as the U.S. Treasury asset, the neutral reserve asset of the global financial system, is coming under tremendous pressure and tremendous volatility. There's less and less desire to own it if you are some foreign actor, particularly if you are a foreign actor who may eventually find itself as an enemy of the U.S. as opposed to an ally of the U.S., as we've seen, last year with respect to Russia having their reserves expropriated. You have China, who is a potential enemy. You have various actors in the Middle East who could very easily find themselves as enemies of the U.S. At risk of reserve expropriation if, let's say, the Israel-Gaza thing, exacerbates into something that's, even worse than it's already been. So as more of the global East and South want to own less U.S. treasuries, they need to find some neutral reserve asset in order to store excess reserves in. And gold is the logical beneficiary of that. So that is your structural force behind gold. And when you add on to that, these accelerating deficits at 8% of plus of GDP. And look, if we go into the last 3 recessions that the US has had, deficits have blown out to between 8 and 12% of GDP. Well, we're already at 8% of GDP. So if we're going to have a recession now, think about the amount of printing that the government was likely to do in that point. Deficits could blow out to mid-teens % of GDP. I mean, the gold, the dollar in that case, would get flushed, and gold would have a significant revaluation from here. So I think gold is a structural long. It should be a part of everyone's portfolio. Currently, it's not part of the 60-40 portfolio at all. So that's ridiculous, right? I mean, most financial advisors have 0 allocations to gold. They've been trying to buy the dip in duration all year. Seems like if you want to own duration, you should own the ultimate duration asset, which is gold, which has no counterparty risk. So I see more and more folks who will be allocating some percentage of their wealth to hard assets, particularly gold, for the course of the coming months and quarters. Now, if you're looking for a high octane play on this idea too, I think that's where Bitcoin comes in. I think Bitcoin is, rallying for a lot of reasons. One of which is this ETF drama that's going on. It seems as though the SEC is going to allow for a Bitcoin ETF, which really I don't even think is going to be such a huge deal, but it may actually ultimately be a near-term sell the news event. But Bitcoin also benefits from these same dynamics as gold with its fixed supply. And in countries that are becoming, more or having issues about inflation, whether it's Nigeria right now is having a big problem, Turkey, Argentina, and clearly nations that are finding itself, in geopolitical issues and having war issues where there's no currency or there's no ability to store your wealth, and you're being forced to flee your home potentially. The only thing you can leave if you can memorize 12 words, you can leave with a lot of wealth, or you can leave with whatever wealth you have. So there is a dynamic in play where Bitcoin continues to take share of the global monetary system. It's a $500 billion asset. It's just too small if it's going to become part of the financial system in a multipolar world. So I think Bitcoin kind of fits as a follow-on to the reasons that I'm constructive of.
All right. I think we can end it there. And I want to thank everyone again for showing up today, asking some really great questions. And we will do this again, probably FOMC timeframe, just because we'll see if there's any news also that kind of leads up to non-farm payrolls being a little bit more eventful on the 3rd. But otherwise, any final words? I think we've kind of covered everything.
No, I think we've hit it. I mean,
I didn't talk about oil, but we can do that another time.
Yeah, look, I mean,
I think the gold was.
Oil and gold right now are kind of, I think, are in a lot of ways similar. I mean, look, I think if the Middle Eastern situation gets worse, and it potentially can, right, with how Iran is, has dragged itself in, and the U.S. is finding reasons to fight there. I mean, if we were to get some sort of blockade or boycott, whatever it is, where oil supplies are, I mean, oil could gap, pretty easily. If Iran decides to close the Strait of Hormuz, oil is going to move $20 in a flash. So that's on the back of people's minds, I think, as you go into every weekend, that if something were to happen, which is why volatility rises on Fridays now, and why gold and oil seem to rise on Fridays. And then if nothing, if the world doesn't fall apart over the weekend, we get that vol selling on Monday, which is why the markets go up on Monday. I think the NASDAQ is up 15 of the last 16 in a row. And it really just has to do, I think, with the way that volatility goes out on the weekend at an elevated level, and then you lose these 2 days of time, and then 100%. Nothing happens, and then vol gets sold on Mondays, and markets elevate. And that is just a mathematical certainty, and that's why you're
until
getting
it isn't, and until that
but we need the unfortunately unfortunately for the world, if we get a weekend event that leads to vol going up, no one's going to like what Monday looks like, because it's going to be a real disaster. It's going to look like it'll be a limit down. There'll be a lot of concern. It could, is it going to happen this Monday? I don't know. I don't know, right? You have no idea, which is why vol goes out at a bid on Fridays now with the geopolitical risks. But
I can tell you with my intermarket analysis assurance that VIX is not done going down. So I know 2021 is typically where they sell the heck out of it, but it's started. I warned on September 18th, VIX, it's time. It's not done. That's all I can say. That's all I can say. We're in this period of warning. That's why we did this thing today. And we wish everyone a great rest of the week. And thank you so much for your questions. Thank you so much for your comments on the discussion. Again, you know where to find us, LaDucTrading.com, and gave you a little coupon code SAM350. So use it while it's hot. We wish everyone a great rest of the week. Cheers.
Take care.
Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.